Well, good afternoon and welcome to our weekly webinar where we are reviewing where we're at in the current market environment with this coronavirus that has been going on around the world. So I'm broadcasting today from our Mishawaka office, and then I have Beth, Foley, Bill Davis, and Matt Aurenz, our advisor team that is broadcasting from their homes. So welcome to all of them, and thanks for taking their Good Friday afternoon and spending a few minutes to update you on where we are at. So I want to go over the agenda for today, which is we want to cover three major topics. The first one is we're going to talk about the COVID-19 recession update and what's happened, and it seems like really changes happen throughout the day. This isn't once a week, it's not once a month. It's throughout the day that changes happen rapidly. And so we just want to highlight what we think are some of the highlights as we finish off the week. We're going to talk about the volatility update and where we are. We've come off a record year, in the stock market. We haven't had a week like we just had for 45 years. So we're going to talk about our thoughts on that and moving forward, and then we're going to touch on a couple topics on the stimulus update. So let's talk about the update before we move on. So for the panelists, someone want to start us off and talk about the week and where we're at as far as the recession?
Yeah, I think it's gotten really tough, certainly with the unemployment claims now exceeding 15 million in the first 3 weeks. That's going to take us into a recession that's going to take quite a bit of time for us to pull out of.
When we were at the national conference, the Schwab National Conference back in November, Schwab's chief analyst, Liz Ann Saunders, had a graph up and was showing how, we keep approaching these recessionary triggers and then pull back, back and forth over the past 18 months or so. And then today I saw that she has a new graph that basically said, if you don't think we're in a recession, you're wrong. We're definitely there with all of the analytics to support it. So I think, along with Bill, that the unemployment numbers are really going to drive how we come out of this, when we come out of this, as soon as we get over the initial crisis point of the disease itself and the number of people who are infected and deaths and so forth. I think week before last, we cited on this update, it suggests that maybe people go back and find an episode of 60 Minutes where the governor from the Minneapolis-St. Paul Federal Reserve was interviewed, and he said in there that one of the key points of the Great Recession from 2008 and 2009 is that it took 10 years to get everybody back to work and have the unemployment numbers get back to where they were prior to the Great Recession. And we have significantly higher unemployment numbers now. So that should be an indication of the length of time that it could possibly take to come out of this thing and feel that we've got that economic strength again, would be my take on things.
Yeah, and certainly with not knowing when we're going to get the country back open, or is it going to be in pieces or layers, and then how fast will it be open, and limits on how many people will be allowed in restaurants, and all of those things is just unknown. And I know there's been a lot of discussion around we need to get the country back to working and get the country open, and the longer that it does go means a deeper recession. That's how we're thinking about it.
Yeah, thinking about it that way, but also thinking about if, the flip side to it is if it opens up too soon and we get a rebound and have those infections and death numbers go back up again, that could be even more traumatic over time. So it's an unknown, and every day, as you said, Erik, every day more information to help feed into some of those decisions.
Well, especially because we haven't really peaked out on the virus yet. So how can we say that we're even at the tranches of the recession until we've actually gotten through the peak of the virus and starting to see the decline in cases? So we're not going to be able to predict the depth and the length of this recession until we can get the COVID behind us. And hopefully today, you know, whether they were just on talking about that we're possibly approaching the peak. So maybe within the next couple of weeks, we'll see some light at the end of the tunnel and be able to better predict how long the recession is going to extend. But just don't want people to get too optimistic that we can move this recession any more quickly than getting the COVID behind us.
True, because in the apex of the infections and so forth, you know, we talk about flattening the curve. Well, that's kind of hitting the plateau. We don't know when, you know, the decline starts. It's like hit the peak and then a plateau from there, which just continues to feed into the uncertainty.
Another key point or key thing that happened yesterday was the announcement of the Fed putting another 2.3 trillion into the system, buying bonds, helping municipalities and agencies. And so I know we've talked about that as a team a bit already yesterday, and particularly around the bonds part. So someone want to take that and just kind of talk our audience through that?
Yeah, I will. I'm interested to see what comes out next week. I mean, every week is another 2 trillion getting thrown out in the economy. So they didn't wait long to come out with number 2. So, but I do think that when you look at where they're putting money and how they're putting money, it's important. So if you take a look at the graphic on the screen, this is the aggregate bond market index that iShares track. It's the largest bond ETF. And what's interesting about it is you can see obviously the rapid decline. It was a good 9.5% or so decline that decreased in a 2-month period. And so what we saw was even the safe havens, people were losing money. And that became quite frustrating, I think, for a lot of people, especially those with conservative portfolios. You know, why am I down? I have safe haven assets that shouldn't go down. And what we've experienced is in, you know, periods of really dramatic declines, low correlated assets become highly correlated in dramatic events. And so you had oil, you had the stock market, you had credits widening, and so credit spreads widening. So that, you know, again, that just dropped. So, but the Fed pumping a ton of money in, obviously you saw that really quick rebound there. I mean, it's already back up to where it was, which is really good news, especially for the conservative assets. So, you know, when you throw it into municipalities, again, that really helps in an array of bond markets. It's not like everybody owns just the ag. It's not like everybody owns just treasuries. A lot of higher net worth people who use municipalities as tax safe havens. So the spreading out of that paper has definitely been a good use of Fed money. Obviously, it's going to come with long-term effects, but in the short term, it's something that's really helped push that fixed income market back up at a much faster rate than the equity markets. And the equity markets, again, are up 20% from 2 weeks ago. So those are up, but they still have a long way to go.
Yeah, this market was a big surprise to us when the initial pullback started, that the bonds would pull back so significantly. And so it's really an unprecedented infusion of capital that the Federal Reserve has put in to include, you know, because we don't talk about this much, but the bond market's $100 trillion. It's 80% bigger than the stock market. And we don't talk about that very often. So if you have any kind of a freeze up in the bond market, you can have some really bad effects that come out of that. And so that for them to decide to put liquidity into ETFs and then this week put money into high yield bonds that was, high yield bonds were down about 12% at the peak. And this will help, this infusion of capital will help. You can refer to these as junk bonds. I mean, they're really the lower rated companies.
Yeah, our view is, that even, it's a lot of money, obviously, that the Fed has, infused into the system over the last few weeks. But certainly, I think the analysts look at it and we follow that. It's needed. It's a needed thing to keep these markets liquid. And as Matt explained with the graphic, it shows that it needed to have a boost back up.
Yeah, I think the other point is what to Bill's point is, the Fed is buying things like high yield. They're buying all sorts of stuff. And so where that really becomes important is, when corporations raise capital, they're doing it in multiple fashions. Stock issue is one way, debt is another way on fixed income bonds. And, a company can easily suspend its stock dividend, but it has to continue to pay the obligation of the bond yield. And so when you're paying that interest payment, you can't just forego that. That has to mature, that has an interest rate attached to it. So you either default on that and it goes away, or you continue to pay. And so for retirees who really depend on the interest from that fixed income asset, the support of this money being infused is really it's a big deal. It's not something that we take lightly.
Yeah, good comments. So if we move on to what volatility means and how we measure it, and so we thought that many of you on the call today may have heard in some form or fashion a volatility index, or the VIX as they call it. And what does that mean? How we look at it, how do we track it? And so why don't we share, kind of the basis around the VIX.
I'll start. So the VIX is an index that was developed by the Chicago Board of Exchange back in the early 90s. It is forward-looking. It's measured in real time, and it's forward-looking down the next 30 days or so. And what it is measuring is volatility. In particular, what it's looking for are the high peaks and valleys of volatility. And it doesn't matter if the markets are going up or going down. It's just there's some sort of movement. And when you look at this chart, which goes back to last October up until February 20th, you can see that everything was just kind of smooth sailing. We're kind of rolling along and feeling okay about some things, little stuff here and there with the trade negotiations and so forth, but nothing hugely significant until we got to February, and the first precursors of the COVID virus started coming about, and you can see that the volatility just went off the map. And looking down the next 30 days and peaked up at about 82.69. And you can see that it's come down. So when the VIX index is going down, that's actually a good thing. That's saying that, all right, we think things are going to be a little bit calmer in the future. So when you hear the VIX, if the VIX number is coming down, forward looking, that the next 30 days may be a little bit calmer than the last 30 days. If you see it spiking up again, then that is a measurement of expected anticipation for more volatility or more uncertainty in the market. The VIX is measured, I believe, on the S&P 500, and it has components in it like standard deviation, price earnings ratio, and then a little too deep from what we want to get into today, but also supply and demand of put and call options as well, and the volume of those happening go into the measurement of the VIX.
And I think this ties into what we talked about last week, that we need, we need to see a sign that we have a trading range that's reasonable. And the VIX is just one of those indicators that says the trading range is going to be dramatic, the higher the VIX is. So that's a 41, for example, I think where we closed yesterday would indicate a volatility of about 7%. So you can just take the number, divide it by 6. And so if you looked all the way back the way we were running, we would have a volatility of 2 or 3% in a trading day, where we got all the way up to 13 to 15% in a trading day. And so once that volatility is more predictable, then we can look at doing things like rebalances.
You know, speaking of volatility for us around the really around the state and up in Michigan. So how do we think about the last couple weeks? I mean, we've had a good run up, if you will. We saw what happened with the bond index that we just looked at. Certainly the stock market has, you know, come back some. So how are we thinking about that? Is that good in the end? Are we done with volatility? What do we think?
I think what we've seen is 2 good weeks because the government's put 2 stimulus packages together. And not that there aren't good things out there going on, but the real data still doesn't suggest that we're out of it, right? So earnings are just starting to come out that people are already cutting projections on. Unemployment numbers are going up. Again, I think the real data is going to be, how long does this last? How long do people have to stay at home? And I think, you know, we can't always bank on China's numbers, but seeing Wuhan go back to work, that'll be interesting to see if they receive spikes in new cases, and did they go back too soon, that type of thing. So for me, I think, yeah, there's good things that they're helping out businesses. They're helping out fixed income. They're sending stimulus checks to people. That is all going to help, but there still has to be some underlying fundamentals that have to play out before you can really say, oh, we're out of this.
So the market's really not doing it on their own merit, as we call it.
Not yet. No, I don't think not yet. I also think that the markets were probably oversold. So I do think that there were people who were sitting on the sidelines saying, now's the time to buy, you know, but we're still down 20%. We were down 40. So I think it's definitely better than where it was, but we still have a ways to go.
Yeah, but positive, but we shouldn't be overly optimistic, because we've seen it in the past in 2008 and 9 when we tested the bottom. But as this VIX has shrunk and as the volatility has lessened, we can expect that we're going to find this trading range that we can then move north from. You know, then we can have a steady increase once we get out of this recession, probably third quarter, fourth quarter of this year.
Yeah, I agree with Matt and with Erik too. It's like the economy has to do it without training wheels. And right now the government's been providing the training wheels to help with these numbers. And we need to see some proof that companies can do it and the economy can do it on its own without the stimulus and the large inflows of money to help it along. And, you know, if we were sitting back in November, December and clicking along with the VIX at, you know, 16 or 17 and looking at 41, that would certainly be troublesome for us. So we can't sit here now at a 41 and think that that's okay. We still have a ways to go to get this done.
So we feel as though, I mean, overall that the Fed needed to step in. And Beth mentioned earlier about the interview with the gentleman from up in Minneapolis area on 60 Minutes a few weeks ago now. And that video is on our website under the Volatility Resource Center. I'd encourage you to watch it because we think it's a good clip. But we've seen the Fed come in a few times now, and we've certainly seen the CARES Act and another $2 trillion from Congress, all believe needed, but yet, as you said, Beth, stock market's got its training wheels, and the bond market too. It's not doing it on its own right now. And is there more to come? More assistance to come?
I think there will be, Erik. They're learning now that the business, so that stimulus is in a couple different areas, right? The household stimulus is going to come direct in everybody's bank account that the IRS has on file. The unemployment insurance increase is going to help all those unemployed people, and then what they're talking about adding to is the small business stimulus. So that jammed up the system pretty quickly. That I think SBA would get about 10,000 applications a year, and they had 500,000 in 1 week. Mm-hmm. So, that really set the banks on their heels a little bit, and so now they've identified that they're going to probably need some more small business lending money. The proposal's $250 billion. I think one side of the aisle wants 500, one side of the aisle wants 250, but I'm pretty sure they'll settle on some number in addition, probably next week sometime.
Yeah, it's really remarkable that it was just a week ago that we were talking about the PPP and getting the paperwork in and so forth, and within a week it's totally jammed up, and uncertainty as far as when dollars will be coming out. Some of the major banks, I believe, have stopped taking applications even for them because they just are so clogged up in their system. So more money to support that system would go a long way right now.
Yeah, and it was just that short period of time, right, that they came out with it and rolled it out and wanted to try to get it out there, but you know, you work through those structural things and so forth. So really, volatility is not over. We still haven't found the trading range, and you know, we need to see the markets kind of do some things on its own terms, which probably is not going to happen probably until we see some sort of decline in the cases. That sum it up? Yeah.
Yep, that's
All right. So let's talk a little bit, just a reminder of the CARES package. You know, I know we've been working through with clients and many of you on how it may affect you. And, you know, the CARES Act for some, I mean, the great thing, as Bill said, is it provides a paycheck for a lot of people that don't have a paycheck. So it will provide that. It'll provide loans to the businesses. But there's also some other opportunities maybe that weren't available last year that are available this year for folks. So let's hit some of those highlights.
One of the highlights that I encountered this week as I was meeting with clients that took me a little bit by surprise, and you know, maybe it's a good thing that, you know, our clients are coming to us, is that I encountered on 3 different occasions folks who are over the age of 70 and a half, or 72 now, who have required minimum distributions, who did not know that, didn't know yet that the required minimum distributions have been waived for 2020, and that, you know, there is no required mandated amount that has to come out of IRA, so people don't have to, you know, liquidate lower price shares of something to meet their RMD, or pay taxes on something that they don't have to pay taxes on this year. So part of the CARES Act is the fact that the RMDs have been waived for this year, and I was kind of surprised that the number of people that I encountered who didn't know that quite yet. So that's just something that I wanted to bring to the fore today, so that people understand that that's the case.
Yeah,
the student loan furlough is really going to help a lot of our younger clients and some of our clients' children, that you know, they won't have to make any Department of Education loan payments through September 30th.
But if they do choose to make those payments, because right now effectively interest rate is 0, so if they are able to, that any payments that they make are going to go right to principal, which is a positive.
Right on, yeah.
Right on, Bill.
Well, and you know, the required distribution part that you know, we've talked about is, you know, because of travel restrictions and so forth, and you know, a lot of folks' travel has been canceled or delayed, so maybe they're not spending money, so they don't really need to take out the required distribution. So maybe, you know, it's a Roth IRA distribution as an example, or maybe it's a little bit to charity through a qualified charitable distribution. That still exists. So there's some other opportunities there as well. There's also something to think about that I know I've worked through with some clients. I know others have as well, and that's capital gain loss. You know, you could have some holdings that have some gains, and maybe you weren't going to get out of that position because of some gains, and now you're able to offset some gains with some losses. That puts you in a position to do that now. So that's another advantage. So there's obviously a lot of other things that come with the CARES Act, but you have to take a look at a little bit of the opportunity in each individual situation varies.
Right, and another opportunity, you know, that I used this week was somebody who had already taken out the required distribution. And so that person had the option to either put it back because it was within 60 days. They actually chose to convert it to a Roth IRA. So go ahead and pay the tax and convert it. And, you know, in other years, they wouldn't convert because you can only convert over and above your required distribution if you're already at that age. So it was just a good planning opportunity for that family to look at the next generation and try to move money to an account that'll never be taxed again. So that was a good opportunity as well. So just, again, you got to look at each individual case in your situation.
Yeah, great points. So let's talk about our kind of keys to carry for the week as we go into the week and think about next week. So we're talking 6 to 9 months, not weeks. Bill, you kind of mentioned that with third quarter, fourth quarter, maybe some additional comments on that.
Yeah, I think that, you know, the number of industries that are affected, the number of people that are affected, and what's going to you know, the difficulty to restart this economy once we get the COVID behind us. It's just, I can't get a number that is less than 6 to 9 months. I mean, it's just, I think it's going to be that difficult to get the engine started. But I think once it starts, it'll get back to some semblance of normal pretty quickly toward the end of the year. But we just don't want people to think it's going to be 6 to 9 days or weeks, because I think we just need to trench down and understand that this is going to take some time.
Yeah. Depending on the industries, right? So large gatherings, groups, things like that will probably have some limits to them. Certain area kind of hotspots, as they've been, the healthcare professional has been saying, more limits there versus others. But there's some real challenges. I've seen a lot of discussion this week around even fall events, sporting events, and so sort of large events. How are they going to deal with that? And you know, potentially some of them now starting without any crowds, without any fans in the stands or fans participating. So there's a lot to be done. I've also heard from the restaurants side of it that they're talking about potential limitations on how many people can go in the restaurant, how far they can sit away, not necessarily opening up the bar areas of the restaurant, things like that. So like you said, Bill, it's not a flip of the switch there. Which leads us into, we may still test the lows. I know we've talked about this now, coming off the low that we had. We talked about this over the last few weeks. So let's just, what are the comments there?
I don't necessarily know if we'll touch or test the low. I do think that we will probably see some decline as some excitement wears out and some other data comes. We surely could test the low, but I would be hard pressed to see a decline of 20% from here. That's just me being optimistic, but I don't know. That's my belief. I do think that we will probably see some dips as more data comes out. I do think that when you see the VIX drop as rapidly as it has, that means a lot of times as well volume is decreased. So we're already seeing volume not get back to norms, but it's definitely much lower, which means that things are not on fire sale. So you add some of those components together. You know, it's hard to use historical data all the time when you have things like stimulus come into play, because you just don't exactly know how that's going to shake out. But I do think that we probably won't go just straight up from here. That would be hard pressed to see that happen.
Yeah, I think that's a great point, Matt, that, you know, the stimulus that comes out. And the second thing is, we really have not seen this ever, you know, in shutting businesses down the way it's shut down. You know,
I mean, we're 70% of our GDP comes from consumer consumption. 70%. So if consumers aren't consuming, that's obviously, Bill, you were talking earlier this week, we could see some of the worst second quarter GDP numbers that we've ever seen as a country. That's going to have an influence on stock prices. That might not say that they need to go down 20%, right? Because a lot of that's going to already be priced in, but that doesn't mean that you're just going to sweep it under the rug. I mean, yesterday came out with 6.6 million of new unemployment claims, and it was a banner on every news media outlet for a couple hours, and then stimulus comes out and then just kind of disappeared. That doesn't just go away. So we will see some downside testing, but again, my opinion is it probably won't be another 20% for sure.
Yeah, but I think that it's, again, this just goes to taking the time with this. If 70% of GDP is coming from consumers, and we have, 10% or more of the country unemployed, even as they go back to work, think about the personal debt that may have been accumulated over this time frame to help get them through, savings depleted in order to get people through. So just because things open up again and restaurants are open and, the malls are open and all of these sorts of things, and the car dealerships are open again, people are not going to be running out to spend money because they're just not going to have it. They've got to get themselves back, hopefully back into a secure financial situation again before discretionary spending picks up once again, which will help, pull us out of a recessionary period. But in the meantime, it's going to take a little bit of time to get through that as well.
Yeah. Great. And then the last one there is, we continue to pay attention for those that are clients on the call today. So we are consistently and constantly paying attention. As we said many times, it's changing day to day. Doesn't necessarily change our strategy day to day, but we're paying attention and really wanting to do what's best for the client, as well as these other opportunities, if you will, that have come about. We had the Secure Act that came out on January 1st, and that kind of got pushed aside after everything with COVID-19 came through. But now we have the CARES Act, and so pay attention and ask questions. As Beth said, a couple folks in the required minimum distributions, those are waived for the year, and there's many other things there. And so we always want you to ask us questions. We're here for you. So any questions or any last comments from the panelists?
Hang in there. We're going to keep we're going to keep this up every week. I think we're scheduled to do this every week through May or whatever. And, we'll keep our finger on the pulse, and appreciate people tuning in.
Yeah, and we are here. Everybody's working. The staff is, everybody is at their desks. Well, not today, but working hard. So if you have questions, if there's things that you're unsure about, if you're looking at your March statements and you have questions, pick up the phone and call or send an email. We're your advisors. We're here to help. So give us the opportunity to help if you do have questions or want something, just want to talk something out. One of the things that I'm finding over the past few weeks is spending a lot of time just talking about long-term goals and short-term goals and so forth. So please call us and let us know if there's anything on your mind.
Hey, real quick, there's one quick question that somebody just posted. Durable good inventories must be getting low as many factories are closed or can't get needed parts for assembly. Once consumers go back to work, there may be a shortage of these products. I would say yes.
Yeah.
I was actually just talking to my neighbor who's got a friend who works for 3M up in South Dakota, and he said they're running 24/7 making the N95 masks. You've got a bunch of different factories that have switched over to that because they can't get parts, or there's no point in producing new cars, those types of things. So I do think that we will probably see there's obviously going to be a hiccup in the supply chain. It'll be interesting to see how much, once people go back to work, what that overtime looks like to get things to create some type of normalcy. You'll also probably see some businesses that just won't reopen, who won't make it through this. So market share will get shifted a little bit. You could also see some increased mergers and acquisitions. So it's really difficult to pinpoint exactly what this looks like if it's prolonged, that's for sure. But I do think that even grocery stores now going to things like, hey, only X number of people in the store, only a limit of 2 per person, those types of things. It almost feels like Cold War rationing, but I think it's really just trying to say you can't just stock your shelves and keep everybody else doesn't have an opportunity to buy anything because they do realize that inventories are decreasing. So I'm not sure I know 100% exactly how to answer that question, but maybe somebody else does. But I do think
there'll be pent up demand for a lot of products,
yeah,
and that will help get people back to work more quickly, and it will help the recession. It will help the economy to bounce. So as it's kind of a yin and a yang, right? I mean, it's bad that the durable goods is going to be down and inventories are going to be low, but they're going to be putting people to work to build those inventories up pretty quick once they see that we're at the bottom of the or at the tail end of the coronavirus.
Sure, just a lag to get those, the end products to the end products from the raw goods and move it through the system, the logistics of making all of that happen.
Mm-hmm.
Yeah, and the reality is if China is getting back up to production, that lag that the US is experiencing, if they're still getting a lot of those durable goods from overseas, we probably won't see as much of a hiccup. It would be, I think, completely different if we came back to work before China did, because we depend so much on them. So that, I think, actually plays to our favor, assuming that they don't go back into shutdown because they came out too early.
Great points. Well, Beth, Bill, Matt, as always, thanks again for taking the time here on this Friday afternoon. And I'll wrap up with a couple things. First off, thanks for attending. We appreciate all of those that are attending, and we're continuing to gain more and more attendance every week, and we want to keep you informed. I know I had a couple folks this week share the link with other people that you may know, and we're glad to have them be on this call as well. I'll also say that you can catch more education. We have a show, many of you know this, called Your Wealth Health. We actually launched in the Michiana area on Fox Michiana, Saturdays at 9:30, and that started in March. So you can see us every Saturday, 9:30. It's a half-hour show. We talk about multiple educational products. Obviously, as of recent, we've been talking about the economic downturn and the recession. So I would encourage you to watch either on Fox Michiana, or you can also catch that on the website. We will be here next week, Friday, again, 3 o'clock, to give you an update. As I said, changes have happened really quickly, and so we'll integrate other things as we talk about it and as things get updated. Until then, I wish everyone a great and happy Easter. Be safe. Enjoy your weekend, and we'll see you next week.